Varroc Engineering is the other one. Remember the stock? Interesting because it rose about 15-20% in the last 1 month. It's a company into engineering which has got some marquee clients which include the likes of Tesla. But chunk of the revenue is coming from Indian automakers like Bajaj Auto, which has recently seen a bump up in sales as well. What's also working in Varroc's favor is the shift to a more premium feel for Indian cars. So how do these factors translate into the bottom line for the company? Joining us now to talk about that, as also the quarter gone by, is the company's CFO, Mr. TR Srinivasan. Mr. Srinivasan, good having you. Thanks for joining us on Bloomberg Quint. This is Neeraj here. Good morning. Would you sum up the quarter for us?
Thanks for having me on the show.
No, pleasure having you. Would you sum up the quarter for us? Because the revenues looked strong, the margins probably not as much, as a result of which the bottom line looked, to my mind, absolutely flat.
Okay. It's a fair observation. The quarter gone by has been quite satisfactory from our perspective. So we had a strong top line growth. On a reported basis, we grew 20% on revenue terms. But on a comparable basis, the growth was even more robust, around 29%, adjusting for two effects essentially. One is the first quarter of last year, before the GST was rolled out. Excise duty was part of the revenue, our revenue in India, which is not the case this year. And the second was in our global lighting business, in our North America operation, we had an operation on the interior plastics business, which was a legacy business, which we inherited when we acquired the lighting business, which was non-core for us. And that operation was wound up during the year and phased out. So we had some revenues on that during the first quarter last year as well, which are not there this year. So adjusting for that, top line grew by 29%, which is a very robust growth. And the growth was quite balanced between our Indian business and also the global lighting business. We grew about 28 to 30% in both the businesses over last year. So that way it has been quite satisfactory. All the various initiatives we have been putting together in terms of growing our product and technology portfolio, growing our geographical footprint, increasing our wallet share with key customers, all have been paying off. Again, on the operating margin side, the margins have been stable, adjusting for the one-off things that I mentioned, and some costs relating to the new facilities that we are putting up currently in Brazil and Morocco, which will get commissioned towards the end of this year, and an acquisition we did in Turkey early this quarter. So, and some higher launch activity, which also we had in the global lighting business. So adjusting for this, our margins have been kind of stable. What you see in the net profit level post-tax is been marginal growth, mainly because of the impact of tax. The effective tax rate this quarter has been higher. Combination of two factors. One is our share of profits from India, where the tax rate is higher, is the share of profit has gone up. And secondly, in our Czech Republic operation, which is a part of our global lighting business, we had significant tax credits in the first quarter last year, which we will again be availing this year based on our capex, but the timing wise it goes into the later part of this year. So adjusting for that, I think we have had a fairly satisfactory quarter, I would say.
Okay, so your revenue growth, key positive, it's tracking ahead of most estimates, at least the couple of brokerage notes that I read and what my analysts suggested as well. I'm just trying to think out, Mr. Srinivasan, the reason why the uptick in revenues didn't trickle down to the margins. Maybe due to the startup costs at Morocco and Brazil facilities, higher cost of electronics on new launches, a bunch of these factors, they don't seem to be factors that will be contained in a quarter. They probably last for 2 or 3 quarters. Are we to see these impact like staying put for the next couple of quarters as well, or could they be topping out?
Yeah, so we will be tapering down over the next couple of quarters because the bulk of the startup activities for the factories has already taken place. So the remaining costs, which most of the remaining costs will get capitalized, and the Turkey acquisition, of course, has been completed. The launch activity again was heavy in the beginning of the year. As those activities stabilize and support the increased volumes, that impact also will come down. And the other factor I talked about, which is the phasing out of our interior plastics business also was wound up during the quarter. So you will see that impact less and less in the next 2 quarters. So this one-off factors would gradually fade out in the next 2 to 3 quarters, and you will see the operating margin coming back, should see it coming back quite strongly.
What's the average that you bake in for FY19, Mr. Srinivasan?
Average in terms of?
Average operating margins. You have had a weak quarter 1. You will see some improvement in quarter 2, quarter 3, which will probably show full blown in quarter 4. What's the average operating profit margin?
Yeah, I mean,
ballpark.
Last year we had reported EBITDA margin of around 9, I think for the full year, close to 9%. And we expect that during the year it will improve, and we are targeting improvement of 40 to 50 basis points. So that's our target, which will be more visible towards the later part of the year.
Okay. Would the India business help as well? Because I think you didn't pass on all of the input cost pressures, which if you managed to do, or which you already managed to do in the quarter thus far, it should probably show in the operational metrics on the India business.
Yeah. Actually, the India business already had better margins in the first quarter compared to last year. EBITDA margins grew by 40 basis points in the India business, mainly driven by the top line growth of 28% we had. So what has kind of held back the margin improvement a little bit is the increase in the raw material cost, which is a combination of, let's say, the metal and crude related inputs like polymers strengthening, as well as the depreciation in the rupee, combination of that. And in our business model, there is a time lag with which we pass on these increases to our customers. And the time lag ranges from 3 to 6 months for depending on the customer. So you will see that impact also will moderate in the later part of this year. That's why I'm more optimistic of the margin improvement in the later quarters.
Mr. Srinivasan, one final question really. You are doing a bunch of things here. I mean, one, you have a few startup operations. You're setting up, I think, if I'm not wrong, 4 new plants in VLS, which arguably will be operationalized by the end of FY19 as well. So a bunch of things happening within your company. Are we to see a bit of a J-curve effect onto your top line numbers over the course of the next 3 years, that you ride a particular percentage or a particular revenue number, circa a few 100 crores here and there for the next 2 or 3 or 4 quarters, and then suddenly there is a big bump up that comes in one particular year?
See, in the global lighting business, currently we are the number 6 in terms of market share and size. And our stated ambition is to be one of the top 3 players, which will mean a significant growth we will need to achieve to be able to realize that ambition. So all our business plans are aligned towards that. So out of the 4 new factories that you mentioned, 2 are currently under construction, which will get commissioned towards the later part of this year. And the other 2 are still just have been approved by the board. So activities to set up will start later part of this year, but will go into FY20 thereabouts. So definitely we see big opportunity to grow the revenues across geographies and also with key major global OEMs, where we have won a number of programs in the last 12 to 18 months, which all will get operationalized in the coming 2 years. So definitely we are on the right track in terms of the growth, and we are also actively looking at any inorganic opportunities which may come by.
Yeah, but you still didn't answer my question, Mr. Srinivasan. Would it be a J-curve effect that could come in? And the reason I ask this to you is if I look at the Citi report, they talk about how the net profit for FY18 annualized about 450 crores. Their estimates are that 2021, FY21 or 2021 as the case may be, your profits move up to not or near about 1,000 crores, which is at least 900 crores, which is almost double of what you did in FY18. Right. So in 3 years, your bottom line could actually double, which would indicate that there will be a J-curve effect that will come into place. When does that happen? Does it happen in FY20? Does it happen in FY21?
Yeah, so FY20, FY19, the current year, and FY20 is where we are making a lot of investments, setting up capacities, which will get commercialized and get ramped up. So FY21 probably is the year where we will have the full benefit coming to the bottom line.
You believe these numbers are on target? You could do northwards of 900 crores of net profits in FY21. Is that an internal target too?
See, that's not for me to say. That's more the analyst estimate, which we respect. So they are very well
Analysts would
knowledgeable
estimate
about the
based on some
industry.
guidance given by the
Yes,
management, isn't it, Mr. Srinivasan?
I wouldn't like to comment on that. So they are experts. Their knowledge of the industry is very strong. So we respect that. We have our own internal plans, which and against which we are tracking well, I would say.